we are going to be doing introduction to financial accounting together. So, I'm seeing that there's only one student so far who's in here. So might as well just maybe wait for 2 minutes or so. We'll start at 3 past. Let's just start at 3 past. Allow those that are maybe having challenges to join in, so we can start together. But anyway, guys, we are gonna be doing introduction to financial accounting. So today we're just gonna be doing a background. Basically, it's an introductory lecture where I introduce this topic to you, and I really hope you enjoy it. And I'm looking forward to being with you guys the rest of the semester. And this is how I work. Whenever you have a question, just unmute your mic and speak your mind out. Suggestion, whatever you have, just unmute your mic. Nonetheless, what I really do request from everybody is that whenever you're not having a question or you are just listening, please keep your mic muted, because sometimes the background noise can be a little bit distracting. So it is 3 past. Let us jump straight into it. So let me cast my screen. Oh, where are my manners? So I haven't introduced myself. So I am Donald. You can call me Donald, you can call me Donny, but don't call me Donald Trump, please. I don't like Donald Trump anymore. I used to like him, but I don't like him anymore because he's sanctioning us. Imagine. That's really mean. Anyway, let's leave politics aside and just and talk about accounting a little bit. So, um we have two types of accounting that we're going to talk about mainly in this lecture. Excuse me, there's just something distracting me. I do not know how to remove this. Uh, okay, great stuff. Apologies for that. Um, so we have two types of financial accounts, right? Two types of accounting actually that we're going to talk about. But throughout this module, we are going to be focusing only on financial accounting. But I want to bring your attention to another type of accounting, because we are talking about a background to financial accounting, right? So I want to bring your attention to this type of accounting before we go far. So now, we have financial accounting and we have management accounting or managerial accounting, right? So like I said, it's just to give you a background and an overview of where we are coming from, right? So basically, these are like branches in the tree of accounting, right? Managerial and financial is just like branches in a tree, right? So now, so financial accounting is what we're gonna describe more in detail, because that's what we are covering more. But I am going to speak a little bit, also highlighting managerial accounting so that we are able to distinguish. Okay, so what is financial accounting? Financial accounting is the recording of business transaction and summarizing. So this is very important. So we are recording, then we are summarizing them into financial statements for decision making by the users of those financial statements. So before we even go far, the users of these financial statements, right, are different when it comes to managerial accounting, right? Because I said we are going to be distinguishing between the two. For the first part, right? For the first part of this lecture, that's what we're going to be talking about. Just trying to separate the two concepts, right? So that we don't get confused as we go on from unit 2 going onwards, right? So these are the things that we need to take note of about financial accounting. So financial accounting involves gathering, it involves capturing, and it also involves analyzing financial information. So we gather, we capture, then we analyze. Right. So this information is recorded, right? And then it's summarized into financial statements because it needs to be used for decisions. So I'm shortly going to come into this. Let me not get ahead of myself. So there are two types of accounting, like what I've mentioned at the beginning of this lecture, that we have financial accounting and management accounting, right? So in financial accounting, this is what we have, right? I want us to differentiate a little bit, right? So management accounting is more, this is the main difference for me, is that the users, that's one of the main difference. If ever you are stuck in management accounting, we are talking about more the users of these financial statements are the managers, the management. So this is more internal. That's one thing I need us to focus on. But when we're talking about management accounting, so let's just differentiate a little bit. The time orientation. Hello, is somebody trying to say something, or it's an unmuted mic? Good evening, whoever is using Honor WODLX2. My name is Donald, and I'm going to be your tutor for introduction to financial accounting. May you please mute your mic if you do not have a question. Okay, I'm just going to mute you. Hello? Do you have a question? I can't really hear you right now. Your network seems bad. So what you can do is that you can okay, it seems like it was just an unmuted mic. All right, thank you. That is why I said whenever you don't have a question, please keep your mic muted so that I do not end up thinking that the background noise is a question. All right. Okay, let us continue. So we are doing introduction to financial accounting, and we are doing unit 1, which is a background to financial accounting. Right. My name is Donald. Or you can say Donny, but just don't call me Trump. Please. I don't like that. I don't like that at all. It's really personal. Okay. Anyway, let us continue. So we said in time orientation, these financial, so basically the financial statements of financial accounting, they generally focus on the past. So the transactions or whatever, it's on the past, focusing on the past most of the times, right? And then in management accounting, we are focusing more on the future because remember, this is supposed to tell the management how to invest in the future or where to invest in the building for future purposes, right? So now let's talk about the purpose of this of the information in financial accounting and management accounting. So usually the purpose is general, right? It basically gives us the direction in which the business is going, right? Because it's gonna, okay, we're gonna get to this. Let me not get ahead of myself, but it basically gives us the general direction. But this is specific for management accounting. It's specific because at times it can be broken down into different sections, right? Or different sections of the business, right? Because it is more internal, and we're going to get to that just now. And then the focus here is on the entire organization, right? And like I just said, in management accounting is on segments of the organization. That's why it tends to be specific, because this is general because it's for the entire organization. I hope we understand that. And then now the users, like I said, the users of financial accounting are external, which means that it's investors which want to invest into the business, external investors wanting to invest into the business. But this is more internal on management accounting because this is more for the internal use of the business, for the management of the business, right? Okay, so now the requirements is that here we have the GAAP, which stands for Generally Accepted Accounting Principles, right? So these are the rules which we're going to be focusing on in financial accounting, right? And then in management accounting, it's generally not so restrictive when it comes to rules, but there is what we call the IFRS, which for now we don't have to worry about, but it's more for internal purposes. So really the format tends to be more different because really it's for the internal use of the organization, not for external parties. Unlike financial accounting, where we are preparing this information for external use, right? I hope we are together on that. Okay, so now the frequency, this can be annually or monthly. In financial accounting, the financial statements, you find out that most of the times they are either annually or monthly, right? So in management accounting, it's ad hoc, which means that whenever necessary, they will prepare this information, right? Whenever necessary, right? In management accounting. So now information wise, what type of information are we seeing in these statements that are being prepared? So in financial accounting, it is more financial information. I mean, financial accounting, financial, right? Like pretty straightforward. And then in management accounting, it's both financial and non-financial information. Because remember why? This is for internal use of the organization, right? So level of details. Financial accounting focuses more on the overview, right? On the overview, because right, it is addressing the general public investors, whereas management accounting can be very, very detailed, like I said, because remember, we're speaking of segments of the organization, so it tends to be more detailed, right? So any questions on this, guys? The differences between financial accounting and management accounting, please ask now or forever hold your peace. I mean, peace. Sorry, don't mind me. Don't mind the pun. Anyway, is there any question? I'm just gonna pause a little bit for those that may have questions to ask. If we don't have questions, I'll continue, and I'll take your silence as well as there is no question. Okay, so it seems like nobody has a question so far. So guys, don't be shy to ask questions. Remember, I'm here for you. If I was paying for a class, I would ask. I would ask, even if it's the dumbest of questions. I would ask. Well, that's what I'm here for, to entertain your questions. All right, as long as it's not why can't we call you Trump? I mean, I already told you I can't. I don't like Trump. All right. Anyway, let us continue. So now that we understand the difference between financial accounting and management accounting, we are going to talk about different business combinations, because remember what I said about the users is that these financial statements are for different users, right? So now it is very important to be able to distinguish between these business combinations, right? So the statements that we are making, right, are going to be used by certain users, right? So our users are businesses, right? Our users of these statements are businesses. So we need to understand the different business combinations. So there are different type of businesses which we encounter in accounting, which we will be working with, which we must all know as accountants. And guys, that is what I'm here to teach you about today. It's going to be quite an interesting introduction. Okay, so let's go. So firstly, we have the sole trader. Now, this is a business which is owned by a single person. So it is a business organization which is owned by what? A single person. You know, if we're in classes and I would say, what? And you'd be like, single person, sole trader. Like soul, I don't know how to put it. Sole trader, single person, right? Okay. So now the business and the owner is deemed to be one entity, one legal entity. So which means that the business and the owner cannot be separated. Now there's bad news for the owner, because that means that the owner is liable for any debts which are incurred as a result of the business operation. Do you get me? That means that the owner is liable, right? Meaning they are responsible for any debts which are incurred as a result of the business operation, which means that if the owner is owing, we can literally go and confiscate their private assets because them and their business are one entity, right? So the owner would consequently also complete his tax forms with the income received from his business operations included, right? So in practice, many smaller businesses are sole traders since it is easier to start up and the owner can make his or her decisions. Remember, it's really quite hard to work with a lot of owners. It's so complicated. Right now, I've been working for a certain company which has multiple owners. And trust me, just for one decision to be implemented, it can take ages because there are many owners. Anyway, that's just my personal life, guys. I am just saying that sole traders liable, right? Because they're not separated from the business. They are one legal entity. So which means that any debts, they are liable for them. Right. Let's go to second part, which is a partnership. So now, when we're talking about partnerships now, a partnership is a business entity where there's a minimum. Remember, now minimum. We're not saying that it's the maximum. Minimum of two partners, right? Of which most of the times it will be like 2, 3 at most in the examples that we've encountered, right? So a minimum of two partners contribute capital and share profit at a predetermined ratio, right? So now these owners are sharing capital, right? They are sharing capital. Partners are jointly liable for any debts. So it's not so much different from the sole trader. It's just now that it's now the partners that are liable for any debt that may be incurred as a result of the business, depending on how much of the business you own, right? Maybe it's 70-30, 50-50. That will determine the liability by how much capital you have invested, right? And it's going to be quite interesting when we're now doing financial statements. You understand why we have to understand these different business combinations, why there's a sole trader, why there's a partnership, and why they have to be treated differently. So now, in general, partners bring their own unique set of expertise to the business and typically has their unique roles within the business. When a partner withdraws or dies, the partnership ceases to exist. So, dun 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 dun, no more partnership, right? When the partner, I don't know why I made that sound so exciting, guys. It's really sad when somebody died, and I didn't mean to be insensitive. That really sounded so insensitive. So anyway, nonetheless, I'm just trying to give energy to this. I know when people hear accounting, they're like, oh no. But my job is to turn accounting from an oh no to oh yes, we're gonna do accounting today. It's a Saturday. I can't wait for the accounting class, right? I believe that that's the point we're gonna get to, guys. Okay, so now close corporation. Now, close corporation is a bit different because it can range between 1 to 10 members. So the type of business is characterized by limited liability. So this is one of the main characteristics of a closed corporation, right? For their owners and is considered a separate legal entity. So now, limited liability basically means that the owner is only responsible for the money they've invested in the company. They are not personally liable for the company's debts. They are basically treated as a separate legal entity to the business, right? So if they're owing, you cannot go and say, oh, you're taking your car because you are owing. They and the company are a separate legal entity. They are only responsible for the money which they have invested in the company, right? Fair enough. Now, for example, if you own shares in a company that goes bankrupt, you would only lose the money that you spent on those shares. They're not going to come and take your property. They're not going to take your houses and your cars, right? but your personal assets, etc., would not be at risk, just like how I explained it. Now, let's go to a company. Guys, hang in there. We are almost done. I know it's so exciting. You're probably wondering, whoa, it's been 22 minutes. This guy has been talking, but it just feels like 5. I know. Thank you. I can be quite energetic. Okay, I'm flattering myself. Now, company. Similar to a close corporation, a company is considered also a separate legal entity, which means that its owners, which are called shareholders, have limited liability relating to any debts which are incurred by the company. Okay, so now owners does not have to be natural persons, but can also be represented by other companies or organizations. This type of business entity is governed by the Companies Act of 2008. In general, companies can be classified as either profit or non-profit. Right. So basically, limited liability, profit or non-profit. I'm sure you've heard non-profit organizations, right? So that's what we're relating to. So now, a profit company's primary goal is ensuring financial gain for its shareholders. So their main purpose is to make sure that there's a financial gain for the shareholders, right? That's what we mean by this company is profitable. Now, non-profit. Non-profit companies' primary goal is not to profit, is not profit, but non-monetary, right? So it could be welfare, right? Social welfare of people, right? Public goal, such as charities. Those are non-profit organizations. Right. So I'm not talking about somebody who says I'm a charity case. You are not a non-profit organization. I'm sorry. And I hope I didn't offend anyone by the joke. But I'm gonna be making jokes. I'm quite humorous. So if you don't like that, please you can suggest and I'll not make jokes. But I believe everybody loves a little sense of humor here and there. Okay, so now we've spoken about different types of business combinations. We've spoken about financial accounting and management accounting. Let us conclude with the accounting equation. This is going to be a very important part in our module, right? The accounting equation. Because when we come to the balance sheet, also known as the statement of financial position, we are going to talk about the accounting equation as well. So when we are hearing this, it better stick. It must be like, it must not go through one ear and go throughout the other one. No, 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 my friend. It must be like, bah, daily bread. You know how you eat bread in the morning, bread and butter. This is your bread and butter, the accounting equation. Okay, so to understand this equation, we need to understand what each of these variables are attributed to, or what each of these variables mean. So now, what are assets? Assets are all belongings of the business, right? They're the belongings of the business. Assets. Pretty straightforward, right? A computer, it could be even cash, right? What are the assets, guys? Help me out, help me out. If you know one, just shout it out. There are so many. There are so many. There are so many. Equipment. What else? We are talking about. Come on, guys, give me assets. There are so many assets. Vehicles of the business, properties of the business, right? Those are assets, right? Okay, so now let us talk about equity. So now equity is the residual interest in the assets of a company after deducting all its liabilities. So equity is what is left, the value that is left in the assets after we remove liabilities. So as we see our accounting equation here, it says assets equals liabilities plus equity. So assets basically is the sum of the liabilities plus equity. So equity is basically assets minus liability, right? That is the description here. The residual interest in the assets of a company after deducting all its liabilities. So in other words, this equation can also be written as this. If you know maths, I will not be teaching maths, guys, but I will certainly be referring to maths. What we mean is that equity is equal to assets plus assets minus liabilities. Right? You just simply mix up your things there mathematically and you get that equation. Let me just put it down here. All right. So it represents the ownership value held by shareholders or owners in the business. Usually equity will be the amount that the owner puts as capital. Right. So now liabilities, pretty straightforward. Liabilities now is the money owed to creditors by the business. Here in South Africa, we have, what do they call them? Amashonisa, loan sharks. That is a liability. If you borrowed money to pay rent, you are in a liability, my friend. All right, let us continue. I hope I don't offend anybody. Okay, so a sole trader invests. So now you're just going to do an example to conclude and maybe to just consolidate this concept. But even if you don't grasp it now, we're going to talk about this until you just, in your dreams, you can assets is equal to liabilities plus equity, liabilities plus equity is equal to assets. That's going to be your dreams. That's going to be your daily bread, right? Okay, so a sole trader invests 300,000 of her own money into a new business, right? In addition, the bank agrees to lend her another 100,000 as capital for the business, right? So in this case, she has acquired 400,000. So she has acquired 400,000, which is 300,000 plus 100,000 of assets. So she has 100,000 in liabilities and therefore 300,000 in equity. So I've just read a lot of gibberish. It's your first time maybe doing accounting and you're like, oh my gosh, I feel like quitting already. What is this? Okay, let us break it down. So a sole trader invests 300,000 of her own money into a business. That's a statement, right? I like to take everything step by step when I'm doing accounting. So what is this? When a sole trader invests 300,000 of her own money, those are the keywords, her own money. Right. So her own money into a business. So that is basically what we call equity. So 300,000 is equity, right? And then in addition, the bank agrees to lend her another 100,000. So 100,000 as capital, right? You cannot see my screen. Oh my days. I think your network is bad because my screen, okay, let me try to stop sharing and start sharing again. Maybe it will help you. Nosipo, can you see my screen? Could you see my screen? All right. Ona, can you see it now? Oh, great stuff. Great stuff. Okay, Nosipo can see it. Ona, can you see it now? Good evening, Mr. or Miss K. I don't know. But my name is Donald or Donny. We are doing Introduction to Financial Accounting. Unfortunately, you are a little bit late, but there is a recording that you can watch of what we did before. So now we are just concluding with this little example. So we are saying that this sole trader has been lent 100,000, right, by the bank. So that's a liability, right? When you are being lent money, you are borrowing money whatsoever, that is a liability, right? All right, I'm glad you can see your screen now. Wonderful. Okay, so in this case, she has acquired 400,000. So that is now our assets, right? Because remember, we already have equity and we have liabilities. assets is equal to equity plus liabilities. So our asset is now 400,000 because it's coming from this 300,000 plus 100,000. So she now has 100,000 in liabilities and therefore 300,000 in equity. Right. So basically you can work around this equation, manipulate it many times. Say you don't have liabilities, you can use equity and assets. Say you don't have equity, you can use liability and assets to calculate their equity, just like how I showed you here. So guys, today we have reached the conclusion of our lecture. I hope everybody has enjoyed, even though some guys were late. Do not worry, there's a recording. You can feel free to watch the recording of everything we have done. Nonetheless, this is Introduction to Financial Accounting, and we did Unit 1, a background to financial accounting. It was really interesting. For those that may have missed the lecture, you are just going to have to watch the recording. Nonetheless, I am Donald. You can call me Donny, but don't call me Trump. Trump doesn't like us. I mean, but let's leave politics. We are doing accounting, right? So, overview for those that just joined in. We did the definition of financial accounting. We distinguished between what we call management accounting and financial accounting. And then we did different business combinations, which is gonna really help us when you're now doing financial statements, right? And then we also did the accounting equation at the conclusion. And this is where we are, guys. So if there are no questions, we can call it a night. I'm gonna say good night, have a lovely night. Thank you all for showing up. I'm your tutor, Mr. Donald. Any questions? All right, guys, since there are no questions, that means that we can conclude the lecture. Till we meet again, have a lovely night, have a lovely weekend. Good night, or well, not goodbye. I sure hope to see you in the next lecture. All right.